Hi, I'm Jimmy. In this video, we're looking at the US economy. Now, every month on this channel, we analyze some leading economic indicators to try to gauge where the economy stands and if it makes sense to invest now or should we wait for another stock market crash. And that video is coming up next week. But in prepping for that video, I came across some unique data that I think could help give us some interesting leading economic information that we wouldn't perhaps otherwise see. And that information is well suited for this type of economy. And hopefully this can help guide us as to the likelihood of another stock market crash and if it makes sense to invest now or again, wait. Okay, so let's jump right in. Now, our first leading economic indicator is the only economic indicator that I've actually used before, and I'm only using it here because it was never really all that popular until today's economy, or it's never been as popular as it is now, and that is the initial jobless claims. Now, I'm sure that nobody's surprised by the shape of this chart. Clearly, this is when the coronavirus lockdown started in the United States, and as things have opened up, well, new jobless claims have gradually drifted lower. But for me, what I do think is a warning sign here is how high the current level is compared to the numbers pre-coronavirus level. Right now, the number, the 1,300 number that we're at right now, that number's in thousands, so it's actually 1.3 million jobs lost, and this is a weekly number. So if we were to clean this up a bit, well, my concern is that over the next few months, how high will this number stay? Yes, I understand that some of these jobs have come back online, but from a broader economic standpoint, you don't want new people hitting the jobless market at this rate. So I do think it's a good thing that this is improving, but I'd like to see it improve faster. Now, if we're curious, I got this data from the US Department of Labor. Okay, now let's switch gears over to the production of raw steel in the United States. This data came from the American Iron and Steel Institute. And obviously, this chart is down. That's to be expected. And that's a bad thing. But the goal of this video is to see if we can objectively gauge where the economy is, ideally, where is it heading? So what I find positive about this chart is that this does seem to be steadily climbing higher, which is a good thing right now. And in theory, if there's an increase in the production of raw steel, well, that would lead to an increase, that could lead to an increase in, let's say, manufacturing, or an increase in the building of buildings or infrastructure projects, things along those lines. Point being, this could be an early sign that things are starting to improve. Okay, now we shift over to a newer economic indicator that I found. This is put out by the Transportation Security Agency, or the TSA, and it tracks the number of travelers. And I'm sure that there's no surprise to any of us that there's less traveling happening right now. But the thing I think is interesting to note here, from an economic perspective, is this bounce. Sure, coming off of the lows, the low of about 100 and some odd thousand, well, this is a crazy good bounce. But if we consider that right here where it's at right now, well, this is about 70% lower than the pre-coronavirus level. Now, on one hand, these results aren't too surprising. Clearly, the whole world has been disrupted by the coronavirus, so there's a drop in almost anything is understandable. But back in March, or even April, I think that most of us were hopeful that once things began to open up, the economy would sort of spring back into action. And I'm not sure that's happening. Of course, that could all change very quickly if we came up with a vaccine or something like that. And I recognize that the reopening of the economy has been a bit trickier than many of us had hoped it would have been. It just caught my attention that things seem to be progressing at a much slower rate than we were hoping. Okay, moving on. So here's another not too shocking economic indicator that I do think will be helpful for many of us to watch. This is the Public Travel Index. Now, I'm not talking about travel like, oh, we're all traveling to Disney World or something like that. I'm talking about it's tracking the public transportation in the major cities around the world. It's published by a group called MOVEit. And really what it does is it tracks in all the major cities, all the public transportation, how many people are traveling in public transportation. In fact, this chart I created was the data from the average of the largest cities that I could find, or at least the data that I could get my hands on. This particular line is the average of New York, Los Angeles, Chicago, Houston, and Philadelphia. And if we're curious to see how each of those individual cities did, That's what that data looks like. Now, if we want, we can zoom in a bit, since that's the more recent time period is probably the most important stuff. And it's probably quite logical that a city like Houston, that's the yellow line, well, they've recently turned lower. So did LA, that's the orange line. And very recently, we see a dip in the gray line, that's Chicago. And understandably, these lines are dipping as the coronavirus worsens, at least in those areas. But what I like about this chart, and what I think a clever investor could do, and could do with this data that I think is kind of exciting, is if we know that public transportation is starting to pick up in a particular city, and that means that more people are moving out and about within that city. And maybe we can assume that the more people that are moving out and about, the more people that are eating out in different restaurants. Well, if we know that, then maybe we can identify some publicly traded restaurants that have a lot of locations in that particular city, or maybe 2 or 3 cities. Because in theory, I would imagine that there's a correlation between foot traffic and restaurant traffic. So this could really be an early warning sign to perhaps a restaurant stock that we're watching, to perhaps that stock bottoming out. And this could prove to be quite good information for long-term investors. And if we don't like the effort that goes into having to gather all this information and figure out this type of insight, well, we could always use our next economic indicator, which is the OpenTable dine-in restaurant indicator. OpenTable recently started publishing this. This is the percentage change from the previous year of diners who sat down in at a restaurant. Not fast food or something like that. Think something along the lines of Ruth's Chris Steakhouse. I think their ticker symbol is RUTH. And for me, looking at this chart, one of the interesting things is over this recent time period here, there seems to be a stalling out as economies, the reopening of economies have been a bit less effective than we would have hoped. Now, I think that the most interesting part of all of this is the fact that despite all of this subpar information, the stock market doesn't seem to be in line with what the economy is doing. And I think this means that we have to continue to be super selective with what stocks we invest in, and we have to do our best to be patient and wait for good bargains. Because I think that it's very possible that we see another pullback in the stock market. If the stock market continues to run up and the economy doesn't catch up to it, I think that could spell a lot of trouble. Now, if we're wondering why the stock market could be running up despite the fact that the economy hasn't quite gotten there yet, I actually did a video where I gave my opinion on that very topic. Perhaps if you're curious, that could be a good next video for you to watch. I got a link right here. I got a link in the description below. And thank you so much for sticking with me all the way to the end of the video. I really appreciate it. Thanks, and I'll see you in the next video.